Добрый вечер, уважаемые дамы и господа. У нас сегодня такое интересное мероприятие. Рассаживайтесь, пожалуйста. Сейчас вот постараемся сделать так, чтобы всем хватило места либо здесь, либо на 4-м этаже. Так что еще несколько минут, может быть, еще небольшой суматохи. Я перейду на английский, чтобы наш гость тоже чувствовал себя комфортно, потому что здесь, в общем-то, все сегодня именно для него и для вас. Спасибо, что пришли, кстати, к нам на биржу. So I'll switch to English now. You know, today's lecture makes me think the following. We've been talking for quite some time that Moscow at one point will definitely become one of the global financial centers. And this particular event actually leads me to think that we are right on the road to that. Because we are really honored here to have such distinguished people lecturing at Mysok Stock Exchange here today in this building in Moscow. And we are extremely glad to see our guests here, yourselves, and we wish you a really interesting lecture and a really interesting discussion here today. I'm not going to say anything at all, because here we have much more important people for this evening than ourselves. So I will ask Mr. Sergey Guriev, whom you probably know well, who is rector of the new economic school in Moscow, to introduce our guest and say a few words about that. And again, thank you for coming. I hope this is going to be a very interesting and thoughtful evening.
Very much. Just in case you didn't know who that is, this is Alexey Rybnikov, the director of Mysok Stock Exchange, the stock exchange of Russia, even though people in RTS may disagree. But we are very grateful to Alexey and to the Mysok team for hosting this lecture already the second time. I see some familiar faces from the last year, where Bob Schiller was giving a lecture right here on this very stage. Let me say a few words about the new economic school and this particular lecture, as I see that I see many students of ours and faculty and alumni, but I see some new faces as well. So the new economic school was established in 1992, and initially that was a program which was supposed to train academic economists and professional economists for government and think tanks, but eventually it turned out that Russian economy was restructuring faster, and Mysok is evidence of that, than its government and its universities. And it turned out that many of our graduates did become academics, but mostly in the US, while the vast majority of our graduates became professional economists in the private sector. And eventually it pushed us into thinking that we should do more for the private sector, since this is our natural partner here in Russia, and we decided to launch a different program, a program for finance professionals, program called Masters in Finance. And we've been very fortunate to find an understanding with Morgan Stanley, who supported this program from the very beginning. And as part of the support, we've established Morgan Stanley Distinguished Lecture in Finance. And the idea of this lecture is to bring an outstanding finance scholar to give a lecture for the general public and for the students and for the faculty of the new economic school, and to engage in a dialogue with the Moscow finance community. This lecture started 2 years ago, when the first lecture was given by Ken Fruit, professor at Harvard Business School, and as I mentioned, the second lecture was given by Bob Schiller, professor at Yale. And today we are very lucky to have Raghuram Rajan, a professor at University of Chicago, both School of Business. It takes me some while to actually figure out the name of the school, which used to be Graduate School of Business at the University of Chicago. The name has changed recently, which is, for some of you, given some food for thought. Mr. Booth gave $300 million to the school to name the school after him, and there are some, while Masters in Finance program is named after Morgan Stanley, the school itself, the new economic school itself, is still called new, even though it's already 16 years old. And so many people sitting here may actually have a career ahead of them and think about donating 300 million, maybe at that time more money, to name the new economic school after them. I'm very happy to see many people, as Alexei said, there is an opportunity to get some seats at the balcony. Unfortunately, in Russia, stock exchange is becoming smaller, while the number of people interested in finance and crisis generally is growing. And this is, I guess, the most visible evidence of that. Let me introduce Professor Rajan. Raghuram Rajan is famous for many things, and those of you who are academics have probably read his papers on a variety of finance topics, and we even handed out a small leaflet mentioning the most important contributions to economics of organizations, to economics of entrepreneurship, to the field which was actually started by a couple of seminal papers that Raghu wrote with Luigi Zingales on financial dependence and growth, on the contribution of financial development to growth. Again, I think some of the people in the room probably have read his book in Russian. It's been translated into Russian 3 years ago, and I'm a big fan of this book, and I'm very happy this book has been published here in Russian. Recently, during the crisis, everybody started to remember another paper that Professor Rajan wrote in 2005 and presented in Jackson Hole conference for central bankers, where his task was to write a paper which showed how less risky the financial system has become because of Alan Greenspan's work. And eventually this paper developed into a paper which showed that things are not well in financial system, and the system is not really functioning in a sustainable way, and that there may be a crisis ahead of us. And now we actually made copies of this paper, which are available at the entrance, so you may look it up too. Professor Rajan also served as the chief economist of the International Monetary Fund, which is one of the most important positions in the world an academic economist can take. And he stepped down before the crisis, so I guess that was interesting time, but I guess this job is much more challenging right now. But again, there is no such, there is no such thing as a former chief economist. You always are part of the debate. Once you step down, you're still part of the debate of international financial institutions, and you also advise the governments. And Professor Rajan is also involved in advising Prime Minister of India and on a variety of issues, but also on financial development. And in this sense, we do have an outstanding academic who's also very active in policy advice. And just to give you an example of how much in demand Professor Rajan is, he already been in Moscow for 2 days. That's his third presentation, if not fourth, right? Fourth presentation. So he's been very busy, and today he will speak about crisis causes and consequences. But before turning the floor to Raghu, I would like to give the floor again to Alexei to say a couple of words, and then to Yulia. Yes, Alexei, please.
У меня маленькое организационное замечание. Я дико извиняюсь, но вскрытие показало, что балкон, как водится, оказался заваленным всяким сугубо биржевым барахлом, поэтому использовать его, к сожалению, не представляется возможным. Значит, 2 места есть впереди здесь.
Да, и вот здесь
можно вот сюда вот вперед сместиться. Я сейчас уйду, еще несколько стульев мы вниз поставим. Пройдите, сядьте, ну, чтобы хоть несколько человек занять.
Да.
Вот, я еще раз прошу прощения, но надеюсь, что интересная лекция, она оправдает все неудобства.
Да. I should say that the number of listeners, the audience is growing exponentially since the lecture number 1 2 years ago. So maybe next year we either need to build a bigger building for MySix, or
мы лучше стулья уменьшим.
Да, отлично. Okay. And I would like to give floor to Елена Titova, who's a member of advisory board of the Masters in Finance program, and she's been a great supporter, a very important supporter of this program from its very start. And from those of you who don't know Elena, she is one of the most successful investment bankers in this country, if not the most successful investment banker. She's a managing director with Morgan Stanley. Elena, please. And she wanted me to apologize on her behalf. She lost her voice. You'll do that.
Okay. Well, thank you for introduction, Sergey. I don't know if being a successful investment banker is a good news today. But I apologize for my voice. I lost it yesterday. I hope to recover it tomorrow. But today it's not with me. So I'll be brief, at least. And what I wanted to say on behalf of the firm that I represent, which is alive and working globally as well as in Russia, is that we're very happy to see all of you here today. And as Sergey said, it's very good and interesting that the audience keeps growing and the people are still interested in the finance profession, even in this kind of times. We're being asked whether our industry is dead. And the answer, I think, who knows, of course, but to me, the right answer is that as long as the economy will be live, right? If life goes on, the banking profession will continue to exist one way or the other. It will have to transform and reform, but will continue to be the blood system of the economic development of the economic system of the world. So it's the right thing to be interested, the right thing to be interested in the financial profession and in finance. Therefore, again, we're very happy to see you all here. Morgan Stanley, as Sergey mentioned in his introduction, has been supportive to New Economic School and the Master's program here because we do believe that it's important to have and develop business and finance talent in this country. It's a new thing. It's still a new economic school. It's one of the leaders, really, in this market, and it's important that it continues to be that way. As to today's subject, the lectures like today, we think, do establish a live dialogue and gives you ability not only to see the professors and listen to them live, but to be able to ask questions, to have a real dialogue there. And it is important, and especially important, in the times like this. And with that, I would want to say that with Professor Rajan's practical experience as well as academic experience, we're very glad to welcome him here today and very thankful for his ability to leave Chicago for 2 days, come back to deliver this lecture and a couple of others, and go back straight away. So with that, I'll give floor to Professor Rajan. Please.
Okay. Well, thank you very much for that kind introduction, Sergey. And I want to take off a little bit on where Elena left it, which is, I think these are very dangerous times. Not because necessarily of the economic crisis that's sweeping the world, but I think it's dangerous because we're also calling to question the whole tenet of capitalism. And that's why I think it's very important for us to understand what happened and to understand that there were in fact aberrations, there were in fact flaws, but that ultimately it doesn't suggest that capitalism itself is broke, that it suggests we need to fix what happened and move on. I think there are very many forces at this point, and I'll point to some of them, which suggest reversing the whole process that has taken us here. The whole benefit of the last 35, 40 years of world integration, of a movement to a more free enterprise system across the world. And my sense is that kind of view is mistaken. Globalization has been good. The emergence and the expansion of financial markets have been good. the advent of a number of transition economies into a full-blown free market system is good. But we must also remember that there are certain aberrations which we've seen over the last few years, many of which have to do with an excessive belief that the market will take care of itself. There is no need for appropriate amounts of regulation. And what we need to do is reverse some of those things that happen without, in fact, totally reversing the capitalist system itself. So, in a sense, my plea, which was in the book that Sergey talked about, that we need to keep the free enterprise system alive, and sometimes that requires saving capitalism from the capitalists. Sometimes it requires saving capitalism from the financiers. But it doesn't mean doing away with either. We need both. We need the capitalists, we need the financiers. We just need to fix this system a little better. So that's going to be the reason for this talk. I don't want to say it's gloom and doom. I want to say that we will come out of this. We will come out of it in time, and we will be stronger and healthier for it. But let's first understand what happened. Sorry, I did something wrong. Okay. Well, I've disrupted the process. Okay, fine. Okay, so what I want to do is talk about four things. First, the causes of the financial crisis, at least what I think they are. Second, what needs to be done in order to, I think, fix the flow of credit again, to get it resuming again. Third, I want to talk a little bit about what regulatory changes might be on the horizon and what I think are sensible and what are less sensible. And finally, I want to step back and talk about the broader consequences of this crisis, because I think that the world, in some sense, is fundamentally changed by what we're seeing happening, and it's been changed in the span of 3 or 4 months. So I want to talk about all this. To start with, what are the causes of the crisis? Well, in very simple and proximate, in simple terms, the proximate causes are there were a lot of bad investments made, financed with a lot of short-term debt. Now, each one by itself would not be enough to in a sense, make the system go bust. But together, of course, they have created enormous problems for the system. So let's ask why it happened. Why did you get bad investments, and why were they financed with short-term debt? And this is an important question, because this happened in the most sophisticated financial system in the world. Why did it happen in the United States, where a lot of extremely smart people populate the financial sector? Well, start with going back to past crises. I think in a sense, this crisis is a child of past crises. If you remember, we had the emerging market crisis here in this country, but also in East Asia in the late 1990s. And across a number of emerging markets in the world, there was a sense that they wanted to change. Never again did they want a crisis, which meant that they focused on building up enough buffers against future crises. This typically meant export-led strategies, whereby they reduced the amount of investment they undertook and increased the amount of savings they were making, both in corporations and by the government and by households. And as a result, you had savings emerging from a number of countries. Now, initially those savings went into corporate investment in industrial countries, and corporations were investing a tremendous amount in the late 1990s, especially in the information technology communications industry, but of course that blew up. And we had the dot-com bust and a substantial collapse in corporate investment in a number of countries after that. So you had this excess desire to save relative to investment in a number of countries, not just the emerging markets, but increasingly countries like Germany and Japan, and somebody had to take the slack. The money, somebody had to produce the investment corresponding to that saving, because as some of you students of macroeconomics understand, you have to have a savings investment balance in the world over. You have to have savings equal investment, because after all, we don't export savings to Mars. In the world, it has to equalize. So if some countries are over-saving relative to their investment, some other country has to be under-saving and investing more than they save. And it turned out that because corporations weren't doing it, the natural place that savings went was household investment. In a number of countries across the world, went into Ireland, went into Spain, went into the United States, went into England. These were all areas where the housing sector started booming and housing construction started booming. Now, this kind of household-led investment was across these countries. However, in the United States, it had a special character. That is, it went much further. And this was where the financial sector helped change things. Essentially, the financial sector was doing something which is quite good. What it was doing was financing housing in Arizona by selling claims on that in Beijing, or selling claims on that in Germany. And the way it did that, I mean, ordinary people in Beijing or pension funds in Germany would not directly buy mortgages on some house owner in Arizona. It doesn't work that way because there's no way you can enforce repayment at such a distance. There's no way you can know who you're lending to. There's a wide gap. Mortgages are local loans, while the stuff that people wanted abroad were arm's length AAA securities. How do you bridge that gap? That's where the financial sector came in. It basically made the local loans, made the local mortgages, and then packaged them together and sold them on to the rest of the world after packaging them and buffering it with enough sort of padding so as to create AAA securities. So the typical number that's often cited from the various papers that have been written is that for $100 of mortgages that I created in Arizona, I could sell $80 of AAA securities around the world. And people were hungry for these AAA securities because they didn't have to worry once they got them. I mean, these were very rock-solid securities, and they were happy to actually hold them. This worked quite well initially, and finance people would say this is a good way of spreading risk, because you're taking that local mortgage risk in Arizona, and instead of holding it on your balance sheet, you're spreading it around the world. It works well so long as the quality of the originations are in fact decent, are reasonably good quality. But what happened over time, especially in 2005, 2006, 2007, was the quality of the mortgages that were made started deteriorating substantially. There were a couple of reasons for this. One reason was that house prices were rising, and they were rising at 10, 12% every year, and there was a sense that was building up in the broker community that all you have to do is get the person into the house. Doesn't matter whether they have no job, no income, no assets. Doesn't matter. Just get them in the house. After a year, the house will have appreciated 10%, and you can refinance because now they'll own 10%, and they can refinance into lower rates. So this is the sort of rationale for what were called ninja loans, loans to people with no income, no jobs, no assets. And there were a variety of those loans that were made. But another thing that was going on also is that lenders or people who put these packages together essentially knew that when they sold these packages on, the people who bought these packages at best could look at hard data, like what is the credit rating of the person who's borrowed the mortgage, what is the loan to value ratio. Now, when a banker makes a mortgage loan and they call the person in and make the loan to them, these are a couple of the things that start the conversation. How much money do you want? What is your credit rating? But then the conversation goes on. You ask, do they have a job? You shake their hand, you look them in the eye. Do they look back or do they look away? When they shake your hand, do they shake firmly or do they give a weak grip? These are what this kind of soft information goes eventually in deciding whether you make the loan or not. So it turns out that in the early phase of origination, in 2001, 2002, when you run a regression on the interest rate that was charged on a loan, And all this information, loan-to-value ratio and credit rating, you can't, of course, capture the strength of somebody's handshake in hard data. But if you regress it against these two pieces of hard information, there is no correlation. It doesn't explain very much. In other words, bankers, when they were originating loans, were focusing on a lot more information than just your credit rating and the loan, the size of the loan relative to value. They were investigating you in great detail. But once they became able to sell the loan down to other people, and they knew that these other people, the only thing they could see was the credit rating and the loan-to-value ratio, they decided that was the only thing they were going to focus on, and forget about all this other information they were collecting. So over time, what you see is the loan-to-value ratio becomes lower, so it looks like you're making better loans. The credit rating of the people you're making loans to goes up, looks like you're making better loans. But you're not embedding all this other information into the loans you're making, and so eventually, credit quality starts deteriorating because the due diligence is much worse. So the loan-to-origination process essentially starts reducing credit quality over time. And of course, nobody notices it because the numbers that they see all look very healthy and look like they're improving. What it needs is a good sort of downturn in order to see the quality of the loans you've made. And of course, as the Fed starts raising interest rates and as house prices stop rising, these natural supports to the lending start falling off, and then you start seeing the quality of the loans you've made look a lot uglier than what you thought. Now, of course, there's increasing evidence that there's also a fair amount of fraud in the originations, which actually makes the picture look worse than just this. So the question, of course, that all of us are interested in is, why did the banks hold on? Now, as I argued, banks originated these loans because there were buyers in Germany, there were buyers in Japan who wanted to purchase these. Those buyers basically wanted there to be a high enough credit rating, so long as it was AAA, their investment policies allowed them to purchase it, no questions asked. So there's a lot of demand for this stuff from what one would call the quote-unquote dumb buyer. There was no necessity for the banks to worry too much. They just originated it and sold it down. The question is, why did they hold on to it? Because a fair number of the losses that we're seeing is because banks held on to this. Now, there are various academic arguments for why banks should hold on to this stuff. One argument, of course, is that if you hold on to it, it reveals that you have confidence in what you're selling, because you have skin in the game. If there are losses, you will bear some of the losses. But that kind of argument typically requires you to hold on to the equity portion. But often, what brought the banks down was not so much the equity portion, but they held on to the AAA portion, the supposedly safe portion. Another argument that's been made is that they held on to it because it was inventory. They were packaging these things together, they were selling them down, but the volume was so great that they had to hold on to a lot of inventory, and eventually the market collapsed and they were left holding all this inventory. That may account for some of what was going on, but the magnitudes don't match up. My sense is that the real answer is that banks really, some parts of the banks were very, very poorly governed, both in terms of the incentives at the top and the incentives of risk managers. Incentives at the top, one example is what happened in Merrill Lynch. Stan O'Neill was the CEO of Merrill Lynch. He saw Goldman Sachs making tons and tons of money in the mortgage origination business. He said, we need to get into this because I need to make profits. And that pressure from the market for Merrill Lynch to make profits caused them to move into the businesses that Goldman Sachs was in, but of course without the same degree of expertise, without the same degree of risk controls, and that created a problem for them. A similar sort of idea is captured by the famous quote from this particular downturn, which surely will be Chuck Prince's statement that when the music's playing, we have to dance. Chuck Prince, the chairman of, the CEO of Citicorp, was asked by the Financial Times in summer of 2007 why are you making all these risky covenant-light loans to firms? Don't you think that they are in fact risky and you could lose a pile of money on it? And his response was this, that I know they're risky, I know we're probably not getting compensated enough, but when other people are making it, I also have to make it. When the music's playing, I have to dance, and the music's still playing. Well, unfortunately, the music stopped, and they were left holding tons of the stuff on their balance sheet, and that is taking them down. So I think part of it was competitive pressure at the top, where CEOs had to justify their existence in a very competitive world, and the way they did it was moving into areas which were somewhat riskier and ultimately created problems. The second, however, was through the organization. And the analogy I like to say here is the compensation systems were such that they rewarded short-term performance. Okay? The analogy is something like, how do you make money without the appearance of risk? So many of these compensation systems did penalize you for taking on too much visible risk. Well, if you're a trader, how is it that you make money without seeming to take on risk? And the answer is you write earthquake insurance. Think about the properties of earthquake insurance. If you write earthquake insurance, if you protect people against earthquakes, you get a premium up front. You get a premium every month. And earthquakes happen very, very rarely, right? So if nobody knows that you're writing earthquake insurance, you look like a genius because you're making money month after month in terms of the premiums you're collecting, but no outflows. Nothing's going out. There's no risk. It looks like you found a source of what traders call pure alpha. However, when the earthquake hits, if you've taken the money out of the back door and you've left the firm decapitalized, there's nothing left to pay the people who you wrote insurance on. A lot of what was going on was essentially writing earthquake insurance, where instead of taking some of the premium and putting it aside for the day the earthquake hit, essentially firms were taking it out as profits. One example, of course, is the credit default swap that was being written, where firms like AIG took large positions without backing that up with sufficient reserves. But another example of this was UBS, whereby UBS, in a mea culpa that was posted on their website, I don't know if it's still there, talked about the fact that certain parts of the bank were essentially borrowing at UBS's AAA cost of capital and investing in AAA mortgage-backed securities and making the spread of 25 basis points and essentially getting rewarded for making the spread. Now, those of you who are in finance know immediately there's no return without risk. If in fact the market is offering 20 basis points more on AAA mortgage-backed securities, it must mean they're riskier, right? But traders in UBS were getting rewarded just for the simple trade of borrowing at UBS's cost of capital and investing in AAA mortgage-backed securities. This is as close to a free lunch as a trader can get, and if you're getting bonuses on this basis, well, you expanded the balance sheet as much as you can. And that's exactly what they did. They expanded UBS's balance sheet enormously on this kind of trade. And of course, when the problems hit, there were enormous losses, and there was no money left to pay. So the real question is, what happened to the risk managers? I mean, these are smart people. These are smart institutions. Why didn't the risk managers stop this and say, are you crazy? You're multiplying this trade 100-fold? There's no way that this can be a source of steady profits or sustainable profits. And the truth is, and I've talked to a bunch of risk managers at these banks, they knew exactly what was going on. And some of them did protest. But the ones who protested really loudly had a problem, which is they had been protesting before. And every time they protested, they had been wrong for the last 5 years because nothing actually happened. This was the benign time when nothing exploded. So every time they said you're taking too much risk, you're putting on too large a position, the trader made another 100 million in the last quarter. So when the CEO hears the risk manager who's been wrong for 5 years in a row and is lucky to have his job, versus the trader who has made 100 million every quarter for the last 6 or 7 quarters, who do you listen to? The risk manager or the trader? And unfortunately, at the point of maximum danger, you always listen to the trader, not the risk manager. So I think risk management systems broke down, in part because times had been so benign for so long. The second part of what I argued was that this was all financed with short-term debt. And part of the reason is that in the upswing, it seems like risk is really remote. Nothing can happen. It's all been very quiet. This is the great moderation. And so short-term debt seems relatively inexpensive. Liquidity problems, unheard of, not going to happen. Everybody wants to lend us money. It's flowing in every which way we can possibly handle it. So why not borrow short-term? Also, in such times, I think short-term debt is the cheapest form of financing, because if in fact you're taking some of these risks, and the market understands you're taking some of these risks, the market wants to be able to withdraw in a hurry. So again, short-term debt is cheaper than borrowing really long-term, because the market knows that it can't withdraw the long-term debt in case you're making losses. So in a sense, in good times, not only do you have an incentive to take on much more debt relative to capital, but the market positively encourages it by putting a very low cost of capital on short-term debt and a much higher relative cost of capital on equity and on long-term debt. And to some extent, all this was aided and abetted by the so-called Greenspan put. What was the Greenspan put? It was the claim made repeatedly by Alan Greenspan and then subsequently to a small extent by Bernanke that the Fed had no ability to discern what was a real bubble. And because it had no ability to do that, the way the Fed would operate was not take any action in case it thought asset prices were going up too high, but once the bubble imploded, it would cut interest rates quickly in order to rescue the system from the consequences of the bubble. So people who herded together understood that if in fact they had liquidity problems, they would all have liquidity problems together, at which point the Fed would come in and flood the market with liquidity, so no problem. Why do we have to bother about getting into liquid positions? We will get bailed out because the Fed has stated it as clearly as it can. So all this, I think, gave an incentive to firms to go illiquid, to go long-term, financed with extremely short-term positions. Now, of course, capital requirements came in the way for the banks and said you couldn't do this because you had to maintain some level of capital. What did they do? They went off balance sheet and they created these special vehicles, SIVs, which essentially were off balance sheet vehicles where you undertook the level of leverage that you really wanted, but did it away from the regulators. So let's recount what happened in the crisis. What we've seen is credit markets have frozen, and only overnight credit is still available for many borrowers in the markets. And of course, one question is, why is this happening? One obvious argument is people are worried about the borrower's credit risk, and certainly this accounts for part of what's going on. Some of the reluctance to lend longer term by banks is because they're worried about their own liquidity position in case lenders want their money back. But a third worry, even for the well-capitalized banks, is that there are so many wonderful opportunities in the market today. And if other financial institutions go bust in the future, those opportunities will become even better. Why do you want to lock up your money in 5-year term loans or even 1-year or 2-year term loans when in fact by keeping your money short term you can actually take advantage of these wonderful opportunities if they show up, right? So I think there's immense pressure both from the fear of not being able to borrow if in case there is a liquidity problem in the near future, if some large financial institution goes bust, and the sort of greed is the wrong word, the desire for taking advantage of the opportunities if a large financial institution go bust, which makes both the poorly capitalized players, the players that have problems, and the well-capitalized players, the players who have no problems, both of them are keeping their powder dry. Both of them are trying to maintain maximum liquidity in the anticipation that we're not out of the woods yet. There are more problems down the line. There are more financial institutions that will fail, and they will create even better opportunities in the one case and even tighter financing conditions in the other case. And that's why a lot of people are keeping liquidity. So in this kind of environment, who is willing to lend long term? The households themselves have no desire to hold these financial assets. They're not willing to invest. They're putting their money in money market securities and in bank deposits. Passive financial institutions, the mutual funds, the pension funds, they have been burnt by these instruments. They have no desire for more. The banks themselves are trying to sell this stuff because their balance sheets are full of it. So the only person, the only entity willing to buy the kinds of financial assets on the balance sheets of institutions that want to delever, that want to reduce the amount of leverage that they have, is the government. So a lot of assets are flowing from the financial sector onto the government's hands. Now eventually that's going to create problems, but thus far, certainly in the United States and to some extent in the United Kingdom and other parts of Europe, the government has been willing to absorb it. So when will the credit markets find a bottom? My sense is it will only find a bottom when the risk of large financial institutions collapsing or being forced to sell assets in a fire sale is relatively small. This is certainly what happened in Japan. It was only when the system was thought to be adequately capitalized, when they closed down the weak banks and recapitalized the large, the healthier banks, that you saw credit starting to resume again. So certainly the weak economy will constrain credit. But even beyond the weak economy, the unhealthy state of the banking sector, the hedge fund sector, the private equity sector, the investment bank sector will hold back until we clean up as much of it as we can. Now we can't clean up, the government can't clean up the shadow financial system, the private equity and hedge funds, because that's not regulated and it has a lot of problems going in. But certainly it can clean up bank balance sheets. And I think that's something that we're going to hope for over the next few weeks, that the Obama administration in the United States comes up with a plan to clean up bank balance sheets by isolating or selling problem assets and by recapitalizing banks through a mix of private and public funds. The problem here, of course, is that a number of banks at market values are actually bankrupt. And so it will mean that either the the US administration will have to acknowledge that fact and take a number of banks into the public sector, or it will have to ignore that fact and try and find a pretense of running these firms in the private sector while actually owning the majority stake. And my guess is it will try the second. It will try. There is a tremendous concern about nationalization in the United States for various reasons, some ideological, and so they will try and continue to have these entities managed in the private sector, even while implicitly holding the majority stake in these firms. I think when the risk of large institutions collapsing is small, when the likelihood of financial assets being dumped on thin markets is small, so the Fed will expand its balance sheet still more in order to buy these assets, and deleveraging will run its course. So I think there's really no alternative to auditing banks, cleaning up, recapitalizing, and shutting down some banks. Some banks will have to be closed and their assets merged with others. To the extent you get private sector participation, the better, but at this time, there is not that much private sector appetite for participation, and so much of it will have to be done by the government. There's a lot of debate about ring fencing versus purchasing of assets. This, to my mind, is really a debate about accounting. When do you account for the losses and the outlays? And to some extent, and we can talk about it in the questions if you're interested, they're pretty much similar, except in one case, when you ring fence, you hide the cost to the government to the future, you hide the fact that the bank is actually decapitalized, you hide that. while when you do the asset purchase, the bank has to recognize the losses immediately. The government has to recognize the fact that a lot of money is being put into the bank immediately, and it makes everything much more transparent. Which do you think the government will choose? Certainly not the transparent process. The ring fencing, to my mind, will be the predominant way things will be done rather than through asset purchases. I doubt they will bite the bullet and nationalize too many institutions. Some will probably have to be nationalized, but they'll be very reluctant to nationalize the really large banks. And so my sense is some intermediate way will be found with them. So the questions for the future in terms of regulation. What do we do going forward? Well, obviously there are extreme views. One extreme view is we need to nationalize the financial sector, we need to run it as a utility. And to my mind, that is probably overstating the problem and overstating the solution. We're not going to get nationalization, we're not going to run it as a utility, in part because the financial sector is so important to the lifeblood of capitalism, to the innovation, to the allocation of resources and so on. It will, in Western countries, largely remain in the private sector. So then we come to second order regulatory suggestions. So one suggestion is, let's increase the capital requirements for these guys. Let's just increase it so that never again do they have this problem. More clever ways of saying that are, let's increase it a lot in good times and reduce it a lot in bad times. So this is what is called counter-cyclical capital requirement. Increasing it a lot in good times so that they cushion, so that they can have the losses in bad times, which eats up that cushion. I think that's a clever idea in theory, but I worry about it in practice. One of the things that we're seeing is that the market's requirement that institutions hold capital differs very much from the regulatory capital requirement. In good times, the market doesn't want you to hold too much capital. That's what we saw. That's precisely why banks could get away by selling assets off balance sheet into these SIVs and running them at very high leverage levels. And the reason, and that's why these investment banks had 40-to-1 leverage ratios and 50-to-1 leverage ratios. The market was very happy with a very low capital requirement in good times. And that means that if a bank is forced to hold an 8-to-1, is forced to be below 8-to-1 leverage or 9-to-1 leverage, the bank will have enormous incentives to sort of send activity into the unregulated sector, away from the regulators, because the leverage that the unregulated sector will allow at that time will be much higher than the leverage that the regulated sector will allow. So that would imply that in good times there will be a lot of what is called regulatory arbitrage. There will be lots of assets moving into the shadow financial sector. Now what happens in bad times? In bad times the regulators want to reduce the capital that is required, but in fact, in bad times, the market wants a much higher level of capital to be maintained. At this point, the market is not happy with 8% risk-weighted capital. It wants 14, 15, 16% of assets being held as capital. You saw President Trichet of the ECB a few days ago complain that the market was demanding too high levels of capital. Well, that's natural. The market in uncertain times like this wants banks to be really, really well capitalized for all the possible losses that may arise. Which then tells me that this attempt to create a counter-cyclical capital requirement is going to be relatively hard. In bad times when the capital requirement by regulators is relatively low, the market will require something much higher. And so the regulatory capital requirement will not be binding, the market requirement will be binding. In good times, regulators want a lot, the market wants little. Again, there'll be enormous incentives for arbitrage. So again, the regulators will have very little effect because a lot of stuff will go on into the unregulated system. So my sense is that it looks good in theory, in practice it's not going to work effectively, especially once banks get over the risk aversion. Second, is Basel II broke? The central bankers will pound on the table and say, no, we just need to fix it a little bit and it'll work again. My sense is it is totally, thoroughly broke. We need to think about Basel II and revisit the entire structure of regulation which it implies. Why? Because amongst other things, Basel II requires the whole risk management process to work through the firm. And we know the risk management process in the firm has broken down. And it breaks down at the point of maximum danger. How can you rely on it? When you can't trust the risk management process in the firm, that whole part of Basel II is out of the window. Of course, capital requirements by Basel II are also out of the window for the first point that I made. So I think we need to rethink regulation from first principles. The central bankers don't want that because they spent 8 years trying to get agreement on Basel II. They don't want to go back into the smoke-filled rooms that they spent 8 years in to revisit capital requirements, to revisit all this, but unfortunately that's what we need. Some people argue changes to the compensation structure are the answer, and I've argued elsewhere that it's part of the answer. That compensation systems which allow a certain amount of clawback of bonuses that were paid for performance are essential when it's really hard for the compensator to understand the risks that are being taken. If the only way you see the risks are with the passage of time, it's only when you see the losses that you know the risks were taken, I think the only way you can compensate is by saying, you've got good performance today, I give you a high bonus, but that bonus is not paid out to you today, it's kept in an escrow account, every year I'll pay a third of it, and if over 3 years there are no more losses in your position, you get the entire amount. If there's substantial losses, I cut back your bonus. Something like that needs to be worked out. It's not rocket science, it can be worked out. UBS now has a system in place. The US government in the compensation systems for the banks it's supporting is also thinking about this. The FSA is thinking about it. I think it's something that's necessary and its time has come. There are people who argue that we can regulate all the problems away, and they're talking about a ton of regulations. My worry is the more regulations we put in, the less effective the financial system will be. At some point, rather than putting more regulations, it's important to think of more buffers. Or to give a different analogy, you can't prevent fires in a town by writing more and more fire code and saying you should do this, you should do that, you should not do this, you should not do that. Ultimately, accidents will happen. You cannot rule out accidents. And so I would argue, rather than creating more and more fire code, we need to think about more and more buffers, that is sprinklers, which will come on when in fact there are fires, to put out the fires. And we need to think about what those sprinklers may look like. One suggestion I have is think about some sort of capital insurance. That is, when in fact the system starts making sufficient losses that it needs a bailout, that you have arranged it ex ante by purchasing some sorts of insurance from the markets, and I can detail such schemes later. But that may be a way of not having the taxpayer come in and pay enormous amounts of money to bail out the system in a way that creates political opposition. And the final question is, how do you deal with too big to fail? And this is, to my mind, the central question that we come out from this crisis with. Because a lot of large banks are basically doing what they want in good times, knowing that in bad times they will be bailed out. And so, given that the G7 has actually made this a tenet that no more large banks will be allowed to fail, and given that future regulators will remember what happened after Lehman, when they allowed Lehman to fail, my sense is you cannot rely on regulatory backbone in the future. No central bank or supervisor is going to allow a large bank to fail unless you make changes in the system. And there are a number of things that could be done in order to make too big to fail less an issue. And one way that I have been proposing is that we have these business continuity plans for large firms. All large firms have a business continuity plan. What happens if there's an earthquake? How do you continue business? I think increasingly we should demand business termination plans from large banks. That is, how do we close you down in 2 days? And you have to detail the process by which you're closed down over the span of a weekend. What such a plan would require is that banks not become too complex. They have to maintain complexity within limits because they have to fulfill a regulatory requirement that they be closed down over a weekend. And this plan should be stress tested every quarter to make sure the bank knows exactly what its assets are, exactly what its liabilities are, where they are, who the counterparties are, so that quickly it can be done. Now, at this point, it's impossible. People are saying the Lehman bankruptcy will take years to resolve. And clearly, there was no focus on closing down entities earlier. My sense is, if you push them, if you focus them, we will bring down the time it takes to close down these entities. And perhaps in 4 or 5 years, we will get down to 2 days, at which point too big to fail is not an issue. And I think we have 5 years. We have 5 years because the financial sector, seared by this crisis, is not going to take more risk over the next 5 years. They will stay quiet, they will do the right things, and it's once the memory of this crisis starts fading that the risk-taking will start in excessive ways. That's when we need the policies in place, and I think this policy is something, with automation, we should be able to achieve. So let me finally end with what I think are important effects from this crisis in this bigger picture. First, I think financial capitalism has been discredited. There was a notion that, for example, financiers were really smart, therefore making enormous sums of money, and they deserved their wealth. The problem when you look at some of these collapses, the obvious example is of Bernie Madoff, that they weren't following anything particularly sophisticated. Again, lowest common denominator being Bernie Madoff, all he was doing was an age-old trick, that is robbing Peter to pay Paul. And he made off with 50 billion from that. And so I think the financial sector has to retrieve its reputation. It doesn't have much right now. And there is a sense that it was ripping off. Undoubtedly, this is untrue, but there is a sense that all the money was being made by ripping off. And I think more fundamentally, it raises questions about the capitalist system's ability to allocate resources and wealth. Why do we believe capitalism worked better than socialism? Because it allocated resources better, it provided better incentives. But for a capitalist system that has been through 2 massive crises, the dot-com bubble and now the credit bubble in the last 8 years, it does raise questions about the fundamental capacity of the capitalist system to allocate resources. A second problem, which is compounding the first, is capitalism works well when you believe it's relatively fair and relatively efficient. You don't want to do away with it because it's efficient, it creates goodies for all of us, and you're not too concerned about it because it's fair. The brilliant, the guys with more ability, they are the ones who make the wealth. What you've seen over the last few years is a tremendous shrinkage, or last few months, a tremendous shrinkage in the wealth of the middle class, right? Especially of the middle class. And these are the guys who typically are the supporters of property, who are the guys who give the voting power for property rights in an economy. And these are the guys who are aggrieved. In the US, for example, the median wage hasn't moved up in the last 20 years. Why were the middle class still happy? Because they saw their house prices go up, which offset the fact that they weren't seeing their paycheck increase that much. Now with their house prices falling, there is angst about the whole system. And there is more willingness for redistributive policies, certainly higher taxes on the rich and so on. So there's a much greater focus on inequality, there's a much greater focus on redistribution. This is certainly going to call for more government action. You already see it in what the Obama administration is proposing. I fear that this will continue and may create more problems down the line. One set of problems it will create, especially in countries that have less of an institutional structure, is political unrest. There are those who are losing and have lost. Especially in emerging markets, there were the guys who were lifted up by the global economy. They are the guys who are the first to lose their jobs now that the global economy has turned sour. These are the people who are in the export-led sector in China. These are the people who are in the financial sector in India. These are the people losing their jobs. And they're a very vocal bunch, they're a very well-educated bunch, and they're going to create more problems in their economies. It's also happened in the US. In the US, it was disguised by the fact that this political unrest occurred during the period of the presidential election. And so to some extent, it's been sort of confounded with the presidential election. You will see that as Obama finds it difficult to deliver the promises that he has made, and after all, he's promised a lot, and as the economy fails to recover quickly, which it will take time, you will see that there will be much more demand for redistribution, for help for the government, for bailing out this, for bailing out that. And if that doesn't happen, there will be much more political unrest in the United States. So I think we are in for a period of political unrest, for an anti-market movement. And how strong that gets depends on whether the policies are effective in getting us out of this before too long. If it is prolonged, we're going to have a lot more questioning of the market economy in the West. I think the effects are going to be deeper and stronger in emerging markets, which don't have the kind of safety nets that the West has, don't have unemployment and health insurance, and where governments are not as well established, where democracy is not as well established. The kinds of concerns are going to be deeper and may in fact come to the fore. So there's an economic side to this recession, but there's also a political side. And if the economic side persists, the political side will become far more important. Eventually, of course, if this persists, we know that political unrest can be diverted into nationalism, and nationalism can be diverted into aggression. And we are very far from that, but that's a concern all of us should have, because that's certainly what happened in the Great Depression. Obviously, we'll have fiscal and policy short-termism. Politicians are very aware of the unrest, and many of them are willing to open the government's coffers as wide as they can to take care of it. They're not worried about the long term, they want to take care of the short term. The problem, to my mind, is there are no easy fixes. Many of the fixes, other than fixing the banking system, are really about letting time reduce the household debt levels, reduce some of the financial sector debt levels, and so on. And politicians, unfortunately, are not willing to wait. They want to do it quickly. And in many cases, they're actually spending too much in wrong ways. And I think that will also be a problem that will stay with us. Finally, I think we see increasing signs of protectionism. The latest was with this bill that's before Congress, where they have Buy American provisions. It's going to come through trade. It's going to come through financial guarantees. It's going to come through employment. The requirement that if I bail a firm out, it doesn't cut employment domestically, it cuts employment abroad. That's a form of protectionism. We're going to see more of that. But particularly for the emerging markets, one concern, it's not quite protectionism, but it is an unequal playing field, is that emerging market governments will have to deal with an environment where they have to raise money when they're competing with industrial country governments raising money. Enormous amount of industrial government paper that's coming on the markets, and it's going to crowd out emerging market papers. So financing is going to become more difficult. Let me end. I don't want to go to the last two slides. I want to leave some time for questions. The countries that will suffer most in the short run, of course, are the countries that have become most dependent on foreign trade and capital inflows and have the least government capacity or resources. And I think we can go across the world and name them. Some of them are in Latin America, and some of them are in Eastern Europe. I think there will be more risks as the recession persists. This is without question. And there's also a question about how we emerge from this recession. Because one takeaway that some emerging market governments could have is that we were abandoned by the international system when we were in trouble. And so the way to deal with this is by building up even more reserves when good times come around, so that we have the buffers if in fact a situation like this should repeat. If that is what lesson countries take away, we're going to have an accentuation of the problems that led to this very crisis, which is the excess savings in some parts of the world. Another response could be that countries move away from integration and say it didn't work. If we exported, those markets died on us. If we imported, financial flows died on us. So really we need to reduce integration and become more closed, and that could well be an outcome. So there are gloomy scenarios possible. Is it possible to end with some cheer? I think yes. I think fundamentally, to my mind, the system is not broke. I mean, the free enterprise system works, and it has its crises. But I want to end with sort of some sort of good news from research. I mean, when you look across the United States, and you look at areas where competition has been relatively low in the financial sector, especially in the banking sector, versus areas where there's been a lot more competition, and you look over time, you find the areas with more competition were the areas that were more prone to crises, that suffered more losses, that suffered more bank failures over time when the crisis came. But in the longer run, those were the areas that actually grew faster and grew more rapidly. So the lesson I take away from this, and again I'd be willing to expound on this questions, is that the capitalist system is subject to crisis for sure, but it also results in the longer term in a higher rate of growth. And what we need to do is try and minimize the periods of crises and minimize the impact of those crises. And with that, I think we should have confidence that in fact we are in the best of all systems. Thank you.
So we do have time for questions. Questions? Yes. We have a microphone, but if you speak loud enough, we can hear you. Could you step up?
Great lecture. Have been thinking about Russia. Have been looking into our situation. What outlook you can give for the next 3 years, in your view?
So I'm not an expert on Russia. I don't want to claim I know anything deep about Russia any more than people here. So take this as a dilettante's view, an outsider's view, very outside. I mean, I think I'm surprised by the extent to which human capital is relatively unused in this country. In the sense that it would seem to me that the scientific and technological powerhouse that Russia is doesn't demonstrate itself in private sector scientific and technological activity to the extent that one would think would be consistent with such a well-trained society. And so I don't see why in the long run Russia should be known for oil, for minerals, for metals. That's to some extent an activity which can be undertaken because you're rich in resources. But it seems to me far more should be done in the other areas. High quality pharmaceuticals, high-tech manufacturing, there's a lot of scope there. How Russia makes that transition to create those industries, to me, seems to be the single biggest sort of question in front of Russia. And I wonder whether, I know that the vibrant financial sector could be created, but that sector, to my mind, is also constrained by the fact that Russia is relatively dependent on the small group of industries. And if there could be more industrial diversification, if Russia could have the full range of industries, I think it could also become a service powerhouse, for example, through the financial sector. It would be less subject to fluctuations in the exchange rate. Why is the exchange rate moving up and down? Because the price of oil is moving up and down. But if you were less dependent on oil, less dependent on commodities, and had a more diversified industrial and service sector, I think it would go a long way. And so it seems to me that there is nothing lacking in Russia to do that. So that's a mystery to me, why Russia is not moving more. One thought could be that it's because of the Dutch disease created by an exchange rate which has been high as a result of oil and mineral prices. That could be an explanation. If that is the explanation, then this crisis offers a silver lining, which is given that the exchange rate is and has depreciated, it can allow these other industries to start becoming more competitive and for things to improve on that front. So, the question I would put forth is what will it take for Russia to do that? Is it the right time? And can it do that? And if it can over the next few years, I think it's a very sound future. That will also, to my mind, creating these industries which are far more dependent on human capital than on natural resources, will also create a much stronger base for property rights and property right protection in Russia than currently exist. I mean, as you know, the studies on the curse of natural resources keep arguing that when a country has too much value created through natural resources, property rights are weaker because natural resources are far more easily seized by the government on whim, while human capital and human capital-based industries are much less liable to seizure and as a result serve as a bulwark against government in country after country. And so, without reference to Russia's specific situation, I think in many ways, from the perspective of becoming a stronger, service economy, from the perspective of utilizing its human capital and bringing back all the talent that has gone abroad, from the perspective of having a more balanced society, I think diversification would be a good thing.
Thank you very much for the lecture. I really enjoyed it. It was illuminating. I have a question about your point of building up sprinklers instead of building up more pipeline. In particular, I'm just wondering what would it mean in terms of financial regulation, financial institutions, particularly you mentioned insurance as a possible sprinkler like that. So I wonder how it should look like so it wouldn't look dangerously similar to the earthquake insurance, which actually brought the system down in the first place.
So I want to actually take it. You want more questions? Okay. I was actually thinking of a way of exploiting the desire to provide earthquake insurance. So here's how it would work. I mean, one example of how it would work. Supposing banks were required to buy insurance, which would pay out when bank losses in the system exceeded, say, 200 billion. In the US, that would be 200 billion. In Russia, it would be a different number. How would it work? The bank would Citibank would issue a bond. It would be called City Capital Insurance Bond. That bond would raise money, let's say $20 billion, and that money would be invested in treasury bills. So it's fail-safe. The interest on the treasury bills or treasury bonds would be paid out to the bondholders of Citibond, and Citibank would add an insurance premium on top of that. So people who hold that bond would get something above the government treasury rate. Now, if the banking system is in trouble and the aggregate losses, accounting losses of the banking system in the last 4 quarters exceed 200 billion, except for Citibank's losses. So we won't count Citibank's losses, so it doesn't have an incentive to create losses in order to get the insurance. But except for Citibank's losses, if the aggregate losses exceed 200 billion, the bond will start paying out, right, to Citibank. So some of those government assets that are inside that fund will be taken and transferred to Citibank's balance sheet. And until the entire 20 billion gets transferred, which will happen when, say, the aggregate losses hit 400 billion. So this looks very much like what is called a catastrophe bond, right? A catastrophe bond is written for earthquake insurance. And basically it pays when the earthquake hits to the insurance company so as to protect the insurance company. This is very similar. It's a catastrophe bond, but against the catastrophe of the banking system being decapitalized. And it's fail-safe because you've already got the collateral. And the people who provide this insurance will earn a premium for providing this fail-safe insurance. Now, the argument against this is it's a very costly form of insurance because people will demand a high premium in order to provide this. That may be, but any insurer is going to demand that kind of high premium. People say there's a problem because those bonds are kept in a lockbox. Well, it's not a huge problem if we have fixed income funds, which anyway are going to hold government treasuries. And they are holding government treasuries here and getting paid an additional premium for holding it. They are providing earthquake insurance, and since they want that additional boost in premium, this is the way they get it. If you've got these people holding the bonds who are diversified across countries, sovereign wealth funds would be a classic example, then they basically can diversify away some of this risk, except for US risk. Basically, most other countries, they can diversify away the risk, so they're fairly protected except against the global downturn. So this would not protect them against global downturns. They would ask for an additional premium against that. But somebody has to bear the loss in global downturns. Better that somebody who gets paid for it up front, rather than the taxpayer who has not got anything for it. Right? So this is a way of moving the cost away from the taxpayer to the investor, and it could work.
Thank you for the lecture. Given the fact that you are the advisor to the Indian government, what do you think is the chance that India and China will become the sort of engines of the global economic recovery and the engines of future growth? And in a way, it's a connected question. If they do become such, what is the chance that US government will not be able to sustain its sovereign debt?
Okay. First, I think India and China are too small at this point to become the channels for lifting. In part, China, because its domestic demand is relatively small compared to its overall size, and India because it's tiny relative to China even. So when you look at market exchange rates, these are not huge countries. And they by themselves are not going to pull the world economy out. They have their own problems, which is why they're slowing. We had a panelist today in the Troika Forum say that he thought China was faking all its numbers and wasn't growing. I'm not that pessimistic about China. I think most knowledgeable observers about China think that it's still growing, but maybe much slower than it was growing, maybe at about 5-6% at this point. India is also likely to grow at that rate next year. These are good rates for the world economy at this point, but relatively small compared to their past growth. But it's not going to be enough to pull the world economy out of trouble. Maybe 5 or 10 years from now, they will be big enough. But right now, I think the industrial world has to figure out its own way of pulling out itself out. The last part of your question was on sovereign.
Sovereign debt of US.
I mean, I think the US is still at its, its debt to GDP is still relatively small. It's 50-50, depending on how you count it, about 50% of GDP. And so trust in the US ability to service its debt is still quite strong. US debt markets are the most liquid in the world. So I doubt there are any concerns. And unlike the euro area, there are no concerns about breaking up and so on. So I have no doubt that the US will be able to manage this for some time. The question is, do they do it big enough and well enough in order to avoid a Japan-like situation? And if they don't do it cleanly, they don't do it quickly, they don't do it in a big enough way, a Japan-like situation could push the debt up very high. So it's important that the steps be taken quickly and in a big enough way. But I think they have the capacity to handle that. I mean, the point is some of these arguments about outlays overemphasize the cost. I'm not talking about the fiscal, but certainly about the financial. When you say TART has already spent 350 billion, well, hopefully some of the assets they hold have value, and so that hasn't been dissipated. So if the economy recovers, I think many of the government holdings can actually turn a profit. But for that, it has to put enough money at work.
Yeah, actually investors in LTCM recover their investments for the profit. Yeah, absolutely.
Okay, well, thank you very much for the lecture, and I have the following. You spoke about financial protectionism, and reason for that was that we now have global banks and national regulation, and first of all, it leads to financial protectionism. Second, we speak of countries like United Kingdom, to possibly become broke at some point. This is a speculation so far, but regarding some other countries, it doesn't sound as much as a speculation. So, do you think that something can be done to fix this problem in the global financial architecture in the future?
Well, I mean, again, you're talking about a version of the too big to fail, but now with the fact that some banks are too big to rescue for some countries. And as a result, you have a double problem, too big to fail and too big to rescue. I really think that we will come out from this crisis with countries rethinking how large banks can be headquartered in their countries. We will also, I think, from individual countries, have more of a desire of national supervisors to ring-fence their assets at some level from the global bank. That is, you shouldn't be able to pull in, pull out assets as and when you want it. That, in a sense, each local bank sits on its own base. And while you can share information, share technology, and sometimes push in capital, pulling out capital into the main bank becomes a little harder, especially beyond a certain point. I think those kinds of things will be contemplated. I do think that we will have a fair amount of discussion on how you supervise these global banks. Certainly the discussion about College of Supervisors is going on. But I think ultimately you can't get away from the point that you're making, that governments and banks are tied together at the hip, so to speak. And so there has to be a government responsible for a bank, or a very clear delineation of responsibilities up front about which government is responsible for which part of which bank. And that discussion again has to take place through the Basel sort of committee and so on, and is again something which needs to happen. So I'm sure they'll work out something, but it is a discussion which hasn't happened and needs to happen.
Thank you for the lecture again, and the question is based on the book Saving Capitalism from Capitalists. Well, in this book you provide us with a very curious stylized fact, according to which the relative measures of financial depth between 1930 and 1980 were at a very low level in comparison to the early 20th century. So in the context of the crisis, we may expect that something similar may take place now, but the question is whether, to your mind, it will be a prolonged period of time, or perhaps these measures will become significant, will become to grow in quickly now.
Yeah.
Thank you.
It's a very good question. I worry about it, which is, what happened in the 30s was country after country passed anti-finance regulation. The US had Glass-Steagall, which broke up the banks. There were some good regulations, of course. The SEC Act and FDIC were in many ways good regulations, but there were some very, very bad regulations. One interesting finding from Enrico Perotti and Nelu von Thaden is they show that, or they argue, and I think Enrico has some evidence showing that countries that where the middle class lost more money, sometimes were wiped out by the great inflations of the 20s and were the countries where there's the least support for finance, and where anti-finance laws were the strongest. So I do worry that because of people who have lost money, because of the revulsion against bankers, as you can see in the US press every day, they keep talking about the furniture that John Thain put in his room. There is a lot of anxiety. And this is a time that everybody who has a plan to constrain the financial sector comes out of the woodwork and says, here's my plan on how to limit them. And that could result in a shrinkage, which I think would be detrimental for growth. It will also accompany a shrinkage in integration, in cross-border trade, cross-border capital flows. So I'm hopeful that this crisis doesn't last long enough for that to be enshrined, and that we sort of come out of it with people saying, look, it's not so much we need a whole new set of regulations, let's do what we did earlier, cleverer, and do a little more, but do it more effectively. Unfortunately, I think right now the political climate is get them, and I think that's a problem. So it could well result in similar outcomes, especially if this downturn is deeper.
What do you think about the probability of the second wave of crisis, this time caused by corporate defaults?
Well, I mean, corporate defaults are obviously increasing. There are many candidates for the second wave. One would be corporate defaults, the second would be emerging markets. Hedge funds, well, they've suffered a lot already. And I think the hedge funds don't default, they just close down. And there's been a lot of closure. I mean, my sense is both those are worrisome and possible. The corporate default I'm not so worried about in countries with good bankruptcy systems. I'm worried much more about corporate defaults in countries that haven't got reasonable bankruptcy systems, and there are many emerging markets around the world that don't have it. There are many corporations that have borrowed a lot in terms of foreign currency borrowing, are heavily exposed, including in this country, and foreign financing is just stopped. And there's only so much that governments can do to replace it. So there's going to be a lot of need for restructuring. If a country doesn't have a good bankruptcy code at this point, it better get one soon. Because that is a form of insurance that it has to have in place in order to do the restructuring. And of course, emerging markets, I think some of them will in fact run out of money, even those with some reserves at this point. So I think it is quite important that, this was a reference to context, I think it's important for our international organizations to get more capacity to lend. Because I also think that in a year or two, emerging markets will be competing with industrial countries to issue paper in the markets. And when you've got competition of that kind, where do you think the money will go? Certainly there'll be a greater preference for industrial country paper. So from a variety of perspectives, I think we need to build insurance very quickly in many ways by creating more power for more resources for the multilateral institutions, and more sort of ease of bankruptcy for the corporations. On the multilateral institutions, one idea that I think is important to consider is some form of reserve pooling across countries, whether in fact collectively countries will have enough, emerging markets can have enough reserves, and whether they can get to an agreement whereby they pool it under some kind of governance structure that they agree to. And this is where I think the emerging markets don't have to keep waiting for the industrial countries to take the lead. They should take the lead themselves and say, this is something that we all need to protect ourselves. Why don't we create such an entity? My disappointment on the international arena with emerging markets is the focus always seems to be, give us more governance rights, give us more voting rights, but very few ideas where the emerging markets take the lead. And this is true of India, it's true of China, it's true of Brazil, it's true of Russia. The ideas are few and far between. And I think it's high time emerging markets said, we're going to take our share of the ideas.
Other questions? Yes, please.
Thank you again for the lecture. As you have said, the Basel II is broken, completely broken, and maybe it's time for Basel III. Now banks have two options. One, standardized approach that relies on external ratings. That approach isn't good because rating agencies hasn't showed good records. And other approach is ARB that relies on internal risk management. That is not good too, because as you have said, when music plays, banks take risks. So in what way supervisors must improve?
I mean, to some extent, I think the movement now is for supervisors to do more of homework themselves. The problem there, of course, is they may not have the capacity to undertake the kind of investigation that is required. So I'm not saying there's an easy answer to this, but I was saying it was broke. I didn't mention the rating, but you mentioned it. That's exactly another reason why it's broke. And the IRB, I have no hope in either. So that's why I think we need to revisit the system and figure out what works better, and maybe some clever ideas come along the way.
Other questions? I have a question on the issue you didn't want to talk about because of lack of time. But basically, again, in the presentation, which is on the website and some copies are available, I would like to ask a question about global financial architecture. What do you think is needed to be done, and what do you think is realistically going to be done in the near future, given that all these challenges to the global system that you mentioned?
So I'll tell you a couple of things. First, I think this is a wonderful opportunity for the rest of the world outside the G7 to get more power. By saying that you're the guys who said you knew what to do, and this crisis clearly shows you don't. So you need to invite ideas from outside, and so long as you run the G7 as a closed shop, and occasionally you run a G8 inviting Russia, it's not going to work that well. We need a broader set of ideas at the table. Now, people are talking about the G20 as an alternative. My concern about the G20 is that the smaller countries in the world have a lot of angst about the G20. And there are some countries that are big that are also left out, like Spain. So I think what we need to do is eventually go towards this kind of structure that's already present right now in the IMF. The IMF has a board which consists of 24 directors from different constituencies, and there's voting. And so there's a rotation in some constituencies. Spain sometimes is the director, sometimes Mexico is the director in charge of that particular seat. So I think if we have the same structure as the IMF board, but had a meeting at a much higher level, that is, twice a year we had a meeting of the heads of government, and maybe 4 times a year had a meeting of finance ministers, and maybe 2 or 3 more times a year we had a meeting of the deputies, that is, deputy finance ministers. That would be a good thing. In addition, so they would talk about economic issues, and the meetings could be more infrequent when it's good times, and more frequent when in bad times, and sometimes, as you see problems approach, it could increase in frequency. The second thing that's needed is get rid of these permanent boards. The fund and the bank have permanent boards, which are staffed typically, and I hope there's nobody who's an ex-fund director here, which are staffed by mid-level government officials whose main job, it seems to me, is to exercise any mention of their country in fund reports. They just want to, don't ever mention my country, good or bad. And they go with a pencil. In fact, I have some fund documents which reflect that. And I think this is a waste of time. These executive board members don't have the power to take large, big decisions. They always have to go back to their country. So they only have the power to obstruct, right? And they also are very conscious that the only place for global dialogue is within the fund board, because that's the only place people meet regularly. And so they guard their ability to undertake, to discuss these things within that board. So those issues never get discussed at the high level that they should be discussed. For example, we should have a full-fledged discussion of the protectionist measures that are being undertaken, and a commitment to not undertake them, which is enforceable, which is verifiable, and to some extent enforceable. It's very hard to get enforceable quickly. But at least let's verify it and then report back. Okay, since your last meeting, these countries have violated the agreement by undertaking actions. That, to my mind, a regular discussion of that kind will improve global dialogue. Okay? We don't have that. We don't have any place where that takes place, and therefore, to my mind, part of global architecture is creating that venue. Chancellor Merkel of Germany says, let's have a United Nations Economic Committee. That is going to be the death of any dialogue. When you have 180 people at the table, you don't get any dialogue, you get speeches at one another. We need a small group. So if you can get the IMFC board and even shrink it further by making the euro area have one seat, you could get a size of about 17, 18 people who are representative, who have legitimacy, and who can take global decisions together. So I think that's important. It's hopefully something whose time has come, and it's something that we'll say. Over time, this body can have more teeth. Once people trust it, they understand that it's not the G7 ruling from a broader group, then perhaps this can have more teeth. So sanctions perhaps could be legislated by this group. If a country continues to flout international norms, for example, runs a large current account surplus forever, perhaps some sanctions can be imposed on that country, trade sanctions of one kind or the other, collectively. And I think once a group has legitimacy, this is possible. So I would move towards that kind of structure rather than at this point say the G20 is doing the right thing. The last thing I would say is I think there's a need for emerging markets to add intellectual contributions to the debate, and that's something whose time has come. All too often, the people who are thinking ahead, who are contributing new thoughts, are the industrial countries, are the G7. And all emerging markets do is react to that stuff. We don't like this, we don't like that, don't do this, don't do that. But never, here's what we think you should do, other than, give us more governance rights. And I think it's time emerging markets respond to it.
Thank you very much. Let us thank Professor Rajan as the food and wine. Let me just conclude taking up these last words that you mentioned and the importance of human capital you emphasized before. It's not a coincidence that on the other side of this leaflet praising academic achievements of WGU, you have a calendar for admissions for Masters in Finance program. And the reason is that exactly right now, as we speak, the Russian government has a dire shortage of talent to suggest new ideas to G20 and to train the new talent. This is exactly why the new economic school was built, and that's exactly why this program was established, and we had the opening ceremony right at this table 3 years ago. And I'm very happy to report that the first class was graduated again in this room, and the new admissions will be open for the next class, and I welcome you all to try to get admitted to this program. This is a much smaller program than this room, so there is never a problem of having no seats in the room. And let me once again say that I fully agree with Raghu that finance is going to be a respected profession once again. Maybe not in 10 years, but much sooner. And it's also an exciting profession. And Professor Rajan and some people in this audience, myself included, are watching it a bit from the outside, and we're very happy. We're very happy to see that there are many exciting things going on in finance, some good and some bad. And let me also give a present to our lecturer. When we designed this present, we never thought it's going to be a crisis that soon. So it's a benign Russian bear. And then there is a T-shirt and a cup with the Masters in Finance